So a central bank holds treasuries in large part because they can liquidate them in any kind of business hours. They can just say, we want to sell the treasury and buy back our own currency. Whereas if they're holding gold, it's the logistics of saying, hey, we just want to sell, $10 billion worth of gold right now. It's hard to do logistically. And so they do hold it for a portion of their savings, the part they don't really plan to touch anytime soon, whereas they hold other assets that are faster.
Mhm.
And for individuals, they start monetizing things like the S&P 500 or oceanfront real estate or lakefront real estate or fine art, right? There's these other monetary things that kind of compete with gold, even if they're not really money in the traditional sense. They're things that they become our primary store of value. They're more efficient. They are powerful.
Mhm.
But a lot of people, especially in developed markets, forget that in developing markets, that's not always available. A middle-class person in Egypt can't easily buy the S&P 500, for
Mhm.
example, and their
Mhm.
local stock market does not have the same long-term store of value properties. And so in those markets, they gravitate toward physical dollars, ironically, or they gravitate toward physical gold. And these are still kind of stores of value in those societies.
Did you know that the supply of gold has only increased by 1 to 2% per year over the past century? Meanwhile, central banks are relying on treasuries, not gold, because cash is easier to liquidate quickly. But Lyn Alden is raising a red flag. This reliance on fiat currencies, built for speed but weaker in value, could be leading us into dangerous territory. For thousands of years, societies have moved towards stronger commodities like gold. But now we're reversing course. What does this mean for your financial security? Could the dollars in your bank account lose value faster than you expect? And is gold still a safe haven, or are we facing new risks with both cash and precious metals?
So in any society, things tend to gravitate toward a common unit of account, which is the most saleable good. Basically, the good that if you were to bring to a market, the highest likelihood that you could sell it for whatever you want. And because otherwise you have a lot of friction in trade. And so generally speaking, some commodities emerge as that which is more liquid, more accepted, and the thing you probably want to store your excess savings in. So most commodities don't really have a monetary premium. They trade based on their utility value, based on their supply and demand, and people don't really store a lot of excess savings in them. They don't just store up barrels of oil, for example. It doesn't have the right properties to do that at scale. And certain commodities start to, in a given technological era, have that feature. So in really early societies, shell jewelry was kind of the thing that, it's the most labor to make it. It's not easy to rapidly increase the supply of, and we can kind of put our excess savings into them. But then over time, basically, anytime you put monetary premium into a commodity, there's a big invitation to dilute it. It's basically saying, look, this is so valuable, we don't know how to make more of it. So if someone does figure out how to make more of it quickly, they get a lot of money. And so over time, as technology improved, we went into the Industrial Revolution and all these other things. We got better at making most types of commodities. We can make all the shell jewelry we want. We can get furs. We can, grow as much tobacco as we want. All these things that were once used as money, it becomes very easy to dilute them. And so people have to always kind of shift toward what is the hardest money to rapidly increase the supply of. And so over thousands of years, gold and silver became the primary answers. That even when, even in our modern technology, we still can't radically increase the supply of gold over any short time period. Only at times where we literally when industrialized societies found new continents, that's the only kind of brief time period where you could kind of temporarily inflate their supply at above average pace.
Mhm.
Because gold and silver have kind of like an inbuilt difficulty adjustment, which is that our technology gets better at finding them over time, but we've also mined a lot of the easiest deposits. So the deposits are getting harder, our technology is getting better, but we're not really increasing the supply too quickly. And if you look at gold over the past century, it's ranged between, and this is like World Gold Council data and US Geological Survey data. There's a couple different data sources you can look at, but gold supply is estimated to increase by 1 to 2% per year on average, and it's been a fairly tight band. You have to go back to the gold rush to find when we kind of meaningfully broke above that, and that was in large part because, again, an industrialized culture was coming to a continent that had not been industrialized yet, so they had a lot of low-hanging fruit to pick, kind of in terms of gold mining for at least a period of time. And so basically, through the process of iteration, societies came to see that gold and silver are the best ones. And the main reason why silver held its value is because gold's key limitation was divisibility. Even a small
Mm.
gold coin was worth more than most purchases. So silver was kind of the more daily use metal. And so this only became challenged in the telecommunication era
Mm.
because prior to telecommunications, speed didn't matter. All commodities kind of moved at the same speed. Things like coinage could help speed up, the act of weighing and verifying, a given commodity. But other than things like that, there wasn't really a big speed difference. But in the telecommunication era, we started to send, and that started in like the mid 1800s with the laying of the long distance telegraph cables. We started to do commerce at large distances very quickly, and so we started abstracting and paperizing everything, and we started kind of getting liftoff away from gold. And so it's kind of the first time we pivoted from a stronger commodity to a weaker commodity, kind of the dollar, like this ledger system it's actually less sound. We spent thousands of years always getting more and more sound from shells to tobacco to silver to gold, and we kind of started reversing because speed was a new variable that mattered. So yeah, it's not an accident that humans settled on gold for so long. It's because it's the commodity with the highest stock to flow ratio, so how much exists compared to how much can be produced in a year.
Hmm.
It's obviously got very good properties for how much value density you can store in it, how long it lasts when stored. Basically, it's not an accident that all of its properties line up to be good money, and then therefore it's used as good money. Yeah, I think that's kind of the phase we're in. I think we're in the early phases of finding solutions. And so the way I put it in the book is that fast transactions are an easier problem to solve than fast settlements, right? So if you have Morse code and telegraph, you can do fast transactions. Two people can talk across the Atlantic Ocean and agree on a transaction. And then the settlement is the hard and slow part, sending and verifying gold. Even in the modern era, when Germany repatriated its gold, they expected it to take like 7 years, and they were happy that it only took like 4 years,
Mm.
which is it's kind of a comical number, and it costs millions and millions of dollars worth of logistics and security and auditing and all these things. Settlements have been a problem. One of the things I cover in the book is that Bitcoin's interesting because it's kind of the first time where we invented fast settlement, which is to say that as long as the network remains reasonably decentralized, I can send you value, and within 10, 20, 30 minutes, your Bitcoin is confirmed on chain, and I have no way to pull that back. It's kind of final settled unless the majority of miners decide to start reversing transactions and things like that. And so that's kind of the first true possibility for finding that solution. But then, of course, it has to go through this very long process of being tested, right? So then people make thousands of other cryptocurrencies, and they say, well, can these do it better? Or can someone find a way to hack it? Or how can it be updated over time to be more efficient? And all these things kind of happen, and it's still a very small market. It's only a trillion plus market cap in global fiat money is something like 100 trillion. Um, and so it's still this kind of early phase to see if that's actually going to be the solution. I think it's a very powerful solution, but it obviously takes time for the market to test it and adopt it. And so as long as we're still in this world where Bitcoin is small, fiat is big, we're still kind of in this weird limbo of, fast transactions, slow settlements.
Mm.
And one of the things you see is that both on an individual level and on a national level, they they consider speed to be a variable. So a central bank holds treasuries in large part because they can liquidate them in any kind of business hours. They can just say we want to sell the treasury and buy back our own currency. Whereas if they're holding gold, it's the logistics of saying, hey, we just want to sell, $10 billion worth of gold right now. It's hard to do logistically. And so they do hold it for a portion of their savings, the part they don't really plan to touch anytime soon, whereas they hold other assets that are faster.
Mhm.
And for individuals, they start monetizing things like the S&P 500 or oceanfront real estate or lakefront real estate or fine art, right? There's these other monetary things that kind of compete with gold, even if they're not really money in the traditional sense. They're things that they become our primary store of value. They're more efficient. They are powerful.
Hmm.
But a lot of people, especially in developed markets, forget that in developing markets, that's not always available. A middle class person in Egypt can't easily buy the S&P 500, for example, and their
Hmm.
local stock market does not have the same long-term store of value properties. And so in those markets, they gravitate toward physical dollars, ironically, or they gravitate toward physical gold. And these are still kind of stores of value in those societies.
Thanks for watching today's video. To recap, we explored some key insights from Lyn Alden on the fragility of fiat currencies and the importance of hard assets like gold. We learned how the supply of gold has been consistently limited, while cash and treasuries offer speed, but come with the risk of losing value over time. As societies continue to shift away from stronger commodities, it's crucial to think about where we store our wealth. If you found this discussion valuable, make sure to subscribe, like, and share the video. And don't forget to drop your thoughts in the comments below.